to today's high-octane explainer. If you're looking for a rapid-fire breakdown of the overnight macro shockwaves and the tactical charts you absolutely need for the trading day ahead, well, you're in the exact right place. Let's just dive right in. We've got to start with this massive number, 10%. Brent crude is surging nearly 10% towards $79 a barrel for the week. This extreme, sudden repricing is setting the stage for a severe, risk-off mood that is currently sweeping across global markets. Section 1. The overnight shockwave and ceasefire collapse. You know, any hope that the US-Iran truce would actually hold has completely evaporated overnight. These geopolitical headlines are moving incredibly fast. U.S. Central Command has confirmed fresh strikes on Iranian targets right in the Strait of Hormuz, while Iran is reporting explosions and actively vowing retaliation. We're also seeing these tensions spill over into Lebanon with an Israeli drone strike. Meanwhile, President Trump has officially declared the peace deal over, threatening a 20-to-1 retaliation and even hinting at seizing Iran's Karg Island. We are objectively looking at a severe escalation here, and, well, the markets are reacting instantly. In response to all this, Wall Street literally split. The Dow and the S&P 500 predictably closed lower, taking the absolute brunt of the early sell-off. But look at the NASDAQ. It staged a massive comeback thanks to NVIDIA and Broadcom. It kind of seems like artificial intelligence still has diplomatic immunity when it comes to macro shocks. Moving to Section 2, FOMC and today's Catalyst watch list. Because while equities split, global bond markets clearly skipped their yoga session, with UK gilt yields surging right alongside oil. So here are your catalysts for today. The FOMC minutes revealed a highly divided, data-dependent committee. You'll want to watch China's inflation data, Germany's trade balance, the ECB meeting account, plus U.S. initial jobless claims, and upcoming remarks from the Fed's John Williams. Section 3. The tactical blueprint for DXY and EURUSD. Let's shift our focus from the macro news down to the actual charts. The U.S. 10-year Treasury yield just surged past its recent corridor to 4.58%, a multi-week high, driven by aggressive de-risking and fresh inflation premiums. For the dollar index, markets are currently pricing in a 76% probability that rates remain unchanged at the next FOMC meeting. The tactical view here is to buy on dips. You're going to want to watch resistance at 101.41 with supports below at 100.89 and 100.57. Definitely keep an eye on today's jobless claims because they will likely test these exact levels. Across the Atlantic, this global bond sell-off is echoing loudly. The German 10-year bond yield climbed to a 4-week high of 3.032%. For EURUSD, we're pairing these technicals with some pretty anemic Eurozone data. Industrial production and retail sales across France and Germany are just weak right now. With today's ECB meeting account dropping, the tactical view is to sell on the rise. Resistance sits at 1.1447 and support is down at 1.1388. On to Section 4, the tactical blueprint for USDJPY and USDINR. We are putting our focus squarely on the Asian currencies that are bearing the absolute brunt of this overnight action. And this stat is just staggering. The Japanese 10-year JGB yield has climbed to 2.880%. That actually marks its highest levels since September of 1996, fueled by escalating inflation and mounting fiscal worries. For USDJPY, there is just no respite. It's testing major resistance at 162.71. Despite persistent worries about Ministry of Finance intervention, traders are testing the upside anyway. So the tactical play? Sell right at resistance with a tight stop. Only buy on a confirmed break, targeting 164.60. Support is sitting at 161.94. Looking at the Indian rupee, it dropped to nearly a one-month low, closing at 95.55. That 6% surge in oil is directly hurting Asian currencies. In fact, PSU banks had to aggressively sell just to cap the losses here. The tactical view remains buy on dips. Next resistance is 95.82, then the pivotal 96.18, with supports hanging at 95.43 and 95.21. Section 5. Nifty technical action and Indian equity markets. India truly took the brunt of the global risk-off mood, with government bond yields jumping to 6.76%. Just look at the sheer magnitude of this crash, a 516.65-point plunge for the Nifty. That marks its steepest single-day fall since March. Selling just spread ruthlessly across large, mid, and small caps. A sector breakdown reveals an absolute bloodbath. Every single index finished in the red, aggressively led by PSU, banks, chemicals, FMCG, and the broader bank index, all down over 2.5%. Only defensive pockets like pharma and metals attempted to limit the losses. So here is the critical technical action for the Nifty today. The index closed exactly at the pivot point. Today's price action right here is absolutely key for portfolio managers. If we break and hold below this pivot, it opens up a definitive sell-on-rise structure with next supports at 23,576 and 23,439. And that brings us to our final line in the sand, 23,866. That massive red bar on the daily chart, we might as well dub it the Trump 1 candle. The geopolitical landscape has shifted dramatically in just 24 hours. So the question you really have to ask yourself going into the trading day is this. If this escalation holds, what exactly is the Trump 2 candle going to look like tomorrow?